I'm Ray Sturm. I am the CEO of AlphaFlow. We are an online investment platform that helps people around the world actually invest in these platforms and build P2P portfolios. And so I wanted to take a bit of a different approach this morning and not just talk about AlphaFlow, but let's take a step back. There's a lot of things we're covering here. There are a lot of platforms out there. There are a lot of investors. Everything's pretty fragmented. So I thought it'd be helpful to take a look and try and tie this all together. Let's take a step back and see what's been happening, where we are today, and really what's coming up in the future. So how'd we get here? Some of the lawyers quickly or not so quickly covered that in 2012, the Jobs Act came around, and we all got kicked, a bunch of us basically started launching platforms. You saw some of the early platforms really get launched in 2013. Platforms like Fundrise, like Realty Shares, like Patch of Land. And in the earliest days, we were scrapping for anything here. I remember being on the phone with sponsors and trying to convince people, give us a single family home, something. These weren't the type of deals that you guys are looking at today. We weren't thinking about millions of dollars. We were thinking about $30,000 or $40,000. Things took a long time, but things continued to grow. And so the industry took off. In 2013, you saw about $400 million go through real estate crowdfunding worldwide. It was a big number. Some people said, that's nice, that looks good, but real estate's pretty big. I don't know if it'll keep growing or if this is just a fad. And then 2014, we hit $1 billion. And all of a sudden, a lot of people's eyes were opened up and things got interesting at that point. And then 2015, this last year, the industry did $2.5 billion. So a lot's changed in that time. The room of people we have here today would not have been possible 3 years ago. It feels like a lifetime ago, but there's a lot that's happened since then. So where are we today? Let's take a look. Next slide. The industry itself is hitting new highs at this point. You've got at least 4 platforms today that have crowdfunded over $100 million worth of real estate. That's pretty amazing. On top of that, you've probably got another 3 to 4 that are doing enough each month now. They're going to hit that number soon. So this isn't the world of a few years ago with crowdfunding basically meaning Lending Club and Prosper. There were 2 companies then that ruled everything. At this point, you've got a lot of great players. And so that means, as we started to build this momentum, Silicon Valley noticed as well. And you saw a lot of big investments come around. So in the last year, you've seen a lot of huge funding rounds. Started out about a year ago. Lending Home, if you're not familiar, an interesting platform, did about $70 million in their Series C. It's pretty incredible for a company that was just started in 2013. A few months later, you saw Realty Mogul go out there, and they did a $35 million Series B. Now, a few weeks ago, if you're reading the newspapers like we are, you see Silicon Valley's dried up. No one's funding anything right now. People are afraid. The wallets are closed. Nothing's happening. Well, 2 weeks ago, Realty Shares goes out and announces a $20 million Series B. Nav in the background over there led that one. It's pretty incredible. So all this attention and all these dollars are leading to some things, though. You're seeing more and more platforms come out. You're seeing some platforms shut down. You're hearing about a little bit winding down. But much quicker than those, you're actually finding more and more platforms. And what you're seeing today, and what we're seeing as we speak with our investors and we're looking at where else to invest, is you're seeing more and more niche platforms. So in the earliest platforms, things like Realty Mogul and Realty Shares, all sorts of asset classes. It's pretty tough today to start something that's going to cover everything. So you're seeing things that are more specific. They're either focused on debt, they're focused on franchises, they're focused on specific regions of the country. So you're going to see a lot more specialization, I think. That's starting to pronounce itself now. There are enough investors out there looking at this space, and you've got different types of investors as well coming to the space. A couple of years ago, we saw some institutional deals. You heard about things where big hedge funds did deals with these platforms. The truth was behind that, it was a commitment, there was a lot of PR, but not a lot of those dollars actually went to work. That's starting to change now. When you've got Patch of Land going out there and they're announcing a $250 million forward flow agreement with an East Coast credit fund, that's big. When you've got Realty Mogul goes out and they partner with an institutional capital source and they bridged a $49 million loan, that's pretty incredible. When ShareStates, an East Coast firm, goes and does a $60 million private equity deal, That's a lot of Wall Street starting to notice, okay, here's a new asset class that has phenomenal returns, and these platforms are actually giving you access. And what that means for a lot of you in the room here today, you hear people say, well, is it not crowdfunding anymore? For those of you looking to fund real estate projects, that means a whole different set of capital for you. For those of you looking to invest on the platforms, that also means access most likely to bigger projects than you ever would have seen yourselves when you're trying to raise maybe $1 million or $2 million. But if you can bring in an institutional capital and bring in another $20 million, you're going to get access to some pretty interesting deals. The other thing you saw come about this year, really in the last few months, is passive investing. You saw a couple of different platforms, including ourselves. We put out Alpha Flow Fund 1, and the mission there was pretty simple. It was, could we raise a fund that would actually invest across the platforms? So the dollars were going back to the platforms, but giving people a passive way to invest in 5, 6, 7 different platforms and sit back and actually have their assets go across 100 different properties maybe. Again, these are more sources of capital for you. And we'll hear more about it in the panel right after this, but I'm excited to hear more about Fundrise's e-REIT. Absolutely revolutionary. This is a structure that's going to give anybody the ability to invest in real estate with really small check sizes. That's impactful, and it's something I'm curious to see if others in the industry actually can use the same structure. So we'll hear more about that from Ryan later. Now, I wanted to step back now and say, let's look ahead, not only to what I think might happen, but people I've talked to in this room, what do you think is coming to the industry? And I also wanted to basically take you behind the curtain a little bit with talking to our investors. We've got investors now that have just under $100 million invested in the real estate crowdfunding space alone on Alpha Flow. So it's a great source of information. It's a great source of people to talk to about not only what they want to see, but eventually, as you all know, eventually what I want to see turns into what I need to see before I'll invest. So let's talk about a few of those things. Far and away, the biggest request when I speak to my users is, can we do standardized metrics? I go to 5 different sites. I see the same deals presented in 5 different ways. I see LTV one place. I see ARV another place. I see preferred returns one place where that means I'm ahead of the sponsor. I see preferred returns another place where that means I'm on the same level as the sponsor. I'm pari with the sponsor, but I'm just behind the debt. What does it all mean? Can we make it clear? Now, all of us in this room want the same thing. We want more funding for real estate. And for on the investor side, what that means is they want great risk-adjusted returns. And for you looking to raise for your own properties, you want to have nice, clean, predictable sources of capital that will fund your projects because you've got great returns set up there. I think one of the quickest ways to get there is for the industry to get behind some standardized metrics. We all win when we get behind this. Now, something we've talked a lot about in the industry but hasn't quite happened yet in real estate is automated underwriting. It's going to make it easier for you to actually submit your deals and see what your rate is. It's what you have on Lending Club today. You go on, you want to borrow money from Lending Club, you put it in, you put in your stats, you put in your FICO, which is really what's been driving it. We need a version of that basically with real estate. I've spoken to a number of platforms over the last 2-3 months, and I've heard again and again, a lot of these platforms are looking to do $250, $350, $500 million in 2016 of crowdfunded dollars. Being practical, the only way to get there is automated underwriting. If you're not, otherwise you're basically building the same old real estate company with a website. You're building an army of underwriters. And it's going to be interesting to see how this happens, how it actually plays out. Now, tied into that is building trust with investors. And you get standardized metrics, you start to get automated underwriting where people understand how things work, and you get a different level of transparency. Now, every platform, as they've increased transparency, you've seen dollars actually go up. Lending Club for years now. Any of you without a membership can go on to Lending Club's website today. You can download an Excel file of every deal they've ever done. Now, on the real estate side of things, we've still kept a little bit of a closed door for one reason or another. If you're not in a deal, most likely you're not seeing what's actually going on in that deal. Our ability to actually open up the industry for everyone, doing that together, working together, is going to bring much more capital to the table, not only from the investors who are in there today, but investors who have been on the sidelines saying, I'm really not sure how this works today. You know, one interesting thing with our fund when we raised this last month was a lot of people wondered, are we just taking the same investors and recycling it back to the platforms? The truth is about 60% of the dollars in that fund are from people who have never put a dollar into real estate crowdfunding yet. So there's a huge audience just waiting around just to try and see what the results actually are with this. How is this actually going to play out? And our ability to be more transparent, both as sponsors and actually going to investors, is going to drive a lot more dollars to us. The other thing that we're seeing more and more is auto invest. Now, a lot of investors, and you see this all the way from Wall Street, you see this on Lending Club, you see it on Prosper, they don't want to pick deals one by one. At a certain scale, the novelty wears off a little bit, and at a certain point, people have other jobs to do. Investing isn't their job. A huge opportunity for us to create an auto investing feature that actually works. Now, I've spoken to a handful of platforms about it, and I know a lot of people are working on it, and what everyone's discovering is it's harder than you thought. And it ties into what we were saying before. Do you have standardized metrics where you can actually measure even your own deals, deal to deal? And that's going to drive the way you make decisions internally. Some pretty complex math behind it, but it'll be interesting to see that actually develop in the industry. Now, some people didn't want me to talk about this, but I think it's important. Deals are going to go bad. We all know this. Investors are adults. They're making decisions based on hopefully clear information. But the economy is not going to keep doing what it's been doing this whole time. Their deals will go bad. And deals have started to go bad on some platforms, and some of that is just stats. You do a few hundred deals, one deal is going to go bad for one reason or another. At AlphaFlow, we've been in an interesting position of being in the center of all this and hearing about how different platforms handle this. How much do they communicate? How much do the developers communicate? Do they shut down, or do they keep communicating with their investors and continue to build trust for future deals? Do the platforms stand behind the underwriting they did? Or if it's a fault of theirs, do they step up and actually give the interest or give the return to the investor that they promised, that they had basically underwritten at that point? We're seeing a variety of these, and I can tell you very openly from talking to investors in these deals, people have handled it very well when people have been open about it. And it's something as an industry we're going to deal with, maybe not only on the deal level, but actually in terms of a whole platform going down. Are we going to be able to step back as an industry together and say there's a reason this platform didn't work out, and that's okay, and there's a reason the rest of us aren't in that same sort of danger? And I think something big coming to the industry is you're going to see more distribution channels. You know, we launched one the other day called the AlphaFlow Exchange, where today people can come on to AlphaFlow and they can see deals from multiple platforms, including Jessica's here from Peer Street. I encourage you to talk to her later. Peer Street's one of our partners. Patch is one of our partners, where you're coming in, you're getting a clearer version of the market. You're seeing everything in one place. And so for you as a sponsor, that means just more liquidity for you. If your deals are shown in more places, if there are more channels to get to your deals, I think one of the things you're going to see, and this was touched on earlier, I think by Howard there, is a lot of the future of this industry isn't going to be people like us one by one picking deals. You're going to see this with registered investment advisors. You're going to see this with hedge funds coming in. You're going to see larger sources of capital automating this, and that creates predictability for you, predictability for actually the platforms themselves, and actually for the investors on the other hand. You get more volume means more predictable returns. So I think there's a lot of exciting things going on in the industry. We're going to bring on 4 founders, or 4 members rather, from 4 of the top platforms here. We're going to do a short panel and dig in a little bit. I encourage you as we do to ask questions if you have them, and it sounds like we're going to dig into the basics a little bit. Thank you.